there, I'm Winnie, co-founder of Hoc-trade. Hoc-trade is building the most innovative behavior trading analytic tool, identifying your personal trading pattern in a fully automated way. After watching today's video, you will know exactly how the Forex and crypto market differ. Both Forex and crypto are two very well-established markets for retail trader. However, the respective market differs in many ways. So today, we're going to have a look at 10 different dimensions of these two markets. You can skip to the respective chapter through the navigation below or by checking the video description. As we will cover a wide array of topics, we split the content into two videos. We will compare the Forex and crypto market and judge the attractiveness, especially for retail traders, based on the following criteria: volatility, liquidity and market volume, fee level, pricing mechanism, and asset variety will be covered in the first video, while asset dominance and correlation, exchange and broker availability, available leverage, trading software, and last but not least, available trading hours will be covered in the second video. The link to the second part of the video you'll find up here and also down below in the description. Without further ado, let's jump right into it. The first dimension we have a look at is volatility. Market volatility is a double-edged sword. On the one hand, trader needs volatility to trade, and some trader, especially experienced trader, thrive during high market volatility. However, on the other hand, very large volatility can also be dangerous for retail traders as it gives very little space for mistake. You can think of volatility as the wind for a windsurfer. Without wind, no one can surf. A little wind is great for beginner, and strong winds are the time experienced surfers go out there and have a lot of fun. Let's have a look at the monthly volatility on the two most dominant assets of both crypto and Forex market: Bitcoin for crypto and EUR/USD for Forex. As you can see, the volatility of Bitcoin is much higher compared to EUR/USD. There are more volatile currency pair in Forex than EUR/USD. However, there are also much more volatile assets in crypto than Bitcoin. In general, the crypto market is significantly more volatile compared to the Forex market, which can, as described earlier, be very attractive to experienced retail trader, and it is probably one of the reasons why so many retail traders started to trade crypto. Given you have a sound risk and money management system in place, the crypto market can hold very attractive trading opportunity for retail traders. At Hoc-trade, we are developing an analysis in which you can directly see how well you perform during high versus low market volatility. You just connect your trading accounts and can see your output of more than 40 analyses, one of which is your average performance per trade in case you traded during low or high market volatility. We are in the last step to finalize the tool, so if you are interested, just subscribe our channel and see right away when it's available. The second dimension we are looking at is the market liquidity and volume. Market liquidity is required in order to perform trades. The higher the liquidity in the market, the less price effect or slippage there is on your trades. You can think of market liquidity as the available offers in the market. Let's make a quick example. You might want to buy a used car at a car dealer. You might either buy a very common car of which many are available, or an exotic car which very few exist in your market. In case you only want to buy one car, as most of you would probably do, you will get a price quote which you can eventually buy the car for. This holds true for the common as well as the exotic car. If you now suddenly want to buy 10 or even 100 of the same cars, the likelihood is still quite high that you can get all of them for a similar price as the price quote for the common car, because there are many of them available at the car dealer. However, if you want to buy 10 of the exotic cars, you will probably pay a significantly higher price compared to the quote for the single car, because not many of them are for sales in your city. And only at much higher price, a few people are willing to sell their exotic car. The very same concept holds true for market liquidity in trading. To execute small transactions, the market liquidity doesn't need to be that deep. However, for large transactions, you need deep liquidity to not face a much higher price than the current market price. In general, the Forex market has deeper liquidity than the crypto market. As a proxy, let's have a look at the average daily market volume. The crypto market has an average daily volume of around 100 billion US dollar a day, while the Forex market has a daily volume of more than 7 trillion US dollar, so like 70 times as much. While volume doesn't equal market liquidity or depth, this clearly shows how much more liquid the Forex market is over the crypto market. The Forex market is much more older and has much more institutional market participants. The crypto market is much younger, and the liquidity might especially become a concern if trading larger volume in less liquid tokens or at exchanges with lower liquidity. If you are an average retail crypto trader and trade only the major token at a large exchange, so you are pretty much buying one common car, you will most likely not feel an effect. However, very large traders may run into slippage issue in the crypto market. The Forex market simply holds much more market liquidity and hence caters better in this dimension to very large traders. The third dimension we have a look at is fee levels. For fees, we have a look at the spread and the commission the broker or exchange charges. Fees are oftentimes very much underestimated by traders. However, in reality, have a huge effect on the trading performance. We did a dedicated video on the effect of fees for traders. I will link it up here as well as down below in the description for you. For Forex fee, broker typically charge only a spread or spread and commission. However, don't be mistaken, if your broker only charges a spread, the spread includes the commission and is significantly higher in case you don't get charged a commission. For crypto, the exchange charges a spread and a commission as well. Let's have a typical trade of one lot, so 100,000 USD round term, so entry and exit in the most common asset. For Forex, this is EUR/USD, and for crypto, it's Bitcoin. At a large Forex broker, an EUR/USD trade usually has a spread of 0.1 pips and a commission of roughly 6 USD for one lot round term. So in total, a trader pays 7 USD for standard lot round term in fees. How about in crypto though? Trading futures at Binance, the largest exchange, you will be having a spread of roughly 0.1 USD per BTC or 0.4 USD for the 100,000 USD round term. The commission is 0.04% per side for taker trades or 80 USD for the round term. In total, you'll be paying fees of 80.4 USD. As you can see, the fees are much higher in crypto compared to trading Forex. Actually, in this example, more than 10 times as much. As a fairly active retail trader with 5 of those 100,000 USD trades a day, 20 trading days a month, your monthly fee in crypto are 8,040 USD. While your fee in Forex would only be $700, that means if you are trading in the crypto market, you must make an additional profit of more than 7,000 USD per month just to recover the additional fees you pay in this example. There are ways to reduce your fees in crypto, and we get to this in the next dimension we look at. But nonetheless, the fee in Forex are much cheaper compared to crypto, which is definitely one of the strongest arguments of trading in the Forex market compared to the crypto market. Next, in the fourth dimension, let's have a look at the difference in the fee pricing mechanism between Forex and crypto trading. There are 3 big differences worth noticing. First, crypto exchanges differentiate between maker and taker fees, while Forex brokers usually do not. Maker fee, so trade executed at the limit order have much lower fees in crypto trading, while taker fee are more expensive. We did a dedicated video explaining the difference, why it is structured this way, and how to save on fees. Again, I'll link the video up here and also down below in the description. In many cases, the maker fees are only 1/5 or even 10% of the taker trades in crypto future trading. The second difference is the tier structure of crypto exchanges versus forex broker. Crypto exchanges have many more tier levels a trader can achieve and thereby lower the fee level. Most exchanges have 10 or even more tier levels, with each tier level giving you a lower fee. The tier can be reached through trading volume, but some exchanges also offer to reach the tier through having a certain amount of balance or holding a certain token. The fee levels in the tier vary a lot, and reaching higher tier level can save you a lot in fees, oftentimes 50% or even more when reaching higher tier levels. With so many crypto exchanges, plenty of tiers and requirements, a manual comparison which exchange suits you the best is pretty much impossible. That is why the easier way is to use an automatic comparison tool such as Dr. V. You can either connect your trading account or enter your spot and future trading volume, your share of maker and taker trade, your account balance, and native exchange token, and within a few seconds, see how much fee you would actually pay at any of the large exchanges. The differences are very, very big. We have seen in a previous example, the fees in crypto are very high, but they significantly differ depending on your trading style and the exchange you use. A comparison can save you many thousand USD in fees. The third difference among Forex and crypto is that Forex broker oftentimes combine all their fees in the spread and advertise their product as zero commission. Crypto exchanges usually charge their commission separately. However, if you see a zero commission Forex broker, that usually only means that the commission is included in the spread. Just have a look at the spread level, mostly spreads of 1, 2, or 3, and more pips are charged. While spread and commission broker have much lower spread, but charge the commission separately. In the fifth dimension, we look at the asset variety in the crypto versus Forex market. In crypto, a retail trader can trade hundreds of different tokens. While the market that might not always be great, it still gives a huge variety to the trader. In the Forex market, there are only that many currencies. Hence, the variety is much lower. In the Forex market, you always trade one currency against another currency. So the relative strength of one currency to another is important for price movement. In the crypto market, especially when trading futures, a trader usually trades the price of a token against the US dollar. We will have a look at the correlation of the different assets in the next dimension. But it can be noted that the crypto market offers a much larger variety of assets to trade compared to the Forex market. Outside the major currencies such as Euro, US dollar, British pounds, Japanese yen, Swiss franc, and so on, the spread gets significantly larger at Forex broker. The commission in crypto always stays the same, with the spread widening at a lower pace in crypto. Many Forex brokers offer additional trading products besides Forex though, which make up a bit for the lower asset variety. Most of the brokers also offer commodity, stocks, metal, and so on. This was the first part of the video. Before outlining what will be covered in part 2 of the video, if you are or if you're thinking of becoming an active trader and you like the content of this video, please leave us a like and subscribe to our channel with the notification bell on. We develop lots of content for traders, and soon our behavioral analytics software will go live, which enable traders to understand their very personal profit and loss-making pattern. When subscribed, you will directly know once we upload all the new content for traders. In part 2, we will cover the following topics: asset dominance and correlation, exchange and broker availability, available leverage, trading software, and available trading hours. Moreover, we will summarize part 1 and 2 of our analysis by listing all the benefit and drawback of trading in the crypto versus the Forex market. Thanks for watching, happy trading, and see you in the second part. Please be aware that we at Dr. Fee are no financial advisor. This video is for entertainment purpose only.